Welcome back to Dreamlit Equity Research. Today we are building the most complete map we have ever produced of the AI and robotics investment landscape. Most AI content gives you a list of companies and a buy or sell call. What it almost never gives you is the why beneath the why, the physics, the supply chain mechanics, and the structural dependency chains that determine which companies win regardless of which AI model ends up on top. That is what this is. We are constructing the complete infrastructure stack from the ground up, starting with the electrons that power the data centers, moving through the silicon that performs the computation, up through the cloud fabric, the intelligence models, and the enterprise software that extracts return on investment from all of it, and then out into physical space, into the robots beginning to embody that intelligence in factories and warehouses right now. 65 slides, 10 investment layers, more than 30 companies, one analytical framework. By the end, you'll understand not just what to watch, but why it matters, which bottlenecks create the most durable pricing power, and what signals to track every quarter to know whether the thesis is intact. This is Dreamlit Equity Research. Let us build the stack, starting as always with 30 seconds of legal housekeeping. Here is the map before we start, because navigating 10 layers and dozens of companies needs a clear architecture up front. We open with a macro thesis, why this moment is structurally different from every prior technology cycle. Then we walk 5 primary layers in order. Energy, the power infrastructure AI cannot exist without, chips and computing, the silicon that performs every calculation, cloud and data centers, the new infrastructure landlords, AI models, the hyperscalers running the intelligence arms race, and applications where AI revenue ultimately crystallizes for the end customer. Cutting across every layer, we dedicate an extended section to robotics, physical AI, the next trillion-dollar frontier. From there, we complete the stack with 5 layers most coverage of this sector leaves out entirely. AI networking and interconnect, server and OEM assembly, in data center power and cooling, NAND storage, and small modular nuclear reactors. We close with the honest part. Red flags, geopolitical fragility, a cross-layer ranking, a quarterly monitoring framework, and the analytical principles I use to evaluate any company claiming AI infrastructure exposure. Every layer gets a declared winner. Every company gets a mode assessment and a risk profile. Let's get the disclaimer out of the way first. Before we go a step further, this content is for educational and research purposes only. I'm not a licensed financial advisor, and nothing here constitutes financial, investment, legal, or tax advice. The views you are about to hear are mine alone, built from publicly available data, SEC filings, earnings releases, investor days, and independent research, and they will change as the data changes. Investing involves real risk. The companies discussed today could compound for a decade or could go to zero. This analysis does not tell you which. Do your own due diligence and consult a qualified financial professional before acting on anything here. Third-party data referenced is used under fair use for commentary and analysis. House is in order. Let's build the stack, starting with the scale of what is actually happening right now. Physical AI is the convergence of 2 trends that, until very recently, live in entirely separate worlds. Artificial intelligence that thinks and machines that act. For 2 decades, AI meant software, recommendation engines, language models, image generators, all confined to a screen. That boundary is dissolving. The same neural networks that write code and hold conversations are now being adapted to control robotic arms, humanoid bodies, and autonomous vehicles in the physical world. This sector report treats that convergence as a single investable system rather than 2 separate stories, because the dependency chain is genuinely continuous. The chips that train a language model are the same chips that train a robot's motion planner. The data centers that serve a chatbot are the same data centers simulating a robot's next million practice repetitions. Today's coverage spans the entire chain: energy, silicon, cloud, intelligence, software, and the physical machines on the receiving end. Let me show you exactly which companies, across which layers, we're going to walk through. Here is the company roster, layer by layer. Energy, Constellation Energy, Vistra, GE Vernova, Oklo, and EOS Energy. Chips and computing, NVIDIA, TSMC, Micron, AMD, and ARM Holdings. Cloud and data centers, CoreWeave, Nebius, Iris Energy, Applied Digital, and Cipher Mining. AI models, Microsoft, Alphabet, Meta, Amazon, and Oracle. Applications, Palantir, Tesla, ServiceNow, Snowflake, and Salesforce. In the supplementary layers, we add networking names Broadcom, Arista, Marvell, and Astrolabs. Server and power names Supermicro, Dell, Vertiv, and Eaton. Storage names SanDisk and Western Digital. And nuclear names NuScale Power and BWX Technologies. Robotics threads through all of it, with dedicated attention on Intuitive Surgical, Tesla's Optimus program, Boston Dynamics, Figure AI, and the broader humanoid field. 35-plus tickers, 10 layers, one continuous investment thesis. Let's start with why this entire build-out is happening at this exact moment in time. Think of the AI supercycle as a vertical dependency chain with 5 layers, each one physically and economically dependent on the layer beneath it. At the foundation, energy. No power, no AI, full stop. Above that, chips, because no silicon means no computation. Above that, cloud and data centers, the physical buildings and networking that let computation happen at scale. Above that, AI models, the intelligence layer trained and serve on top of all that infrastructure. And at the top, applications where AI value finally gets extracted by an actual paying customer. Running across all 5, horizontally, robotics, the physical embodiment of the entire stack. Here is the critical insight to carry through everything that follows. Value capture right now is concentrated in the bottom 3 layers, the physical bottlenecks. NVIDIA's data center revenue, Constellation's oversubscribed nuclear fleet, CoreWeave's sold-out backlog. These are real, contracted, and near-term. The application layer is where long-term value eventually lands, but the investable thesis today is infrastructure first. 3 words to hold on to: on the rails. Let's go find out exactly why this moment is different from every technology cycle that came before it. 3 forces are converging at once, and each would be significant alone. Force 1, compute scaling laws. DeepMind's chinchilla research, established back in 2022, showed that AI capability improves predictably with more compute and more training data, an empirically validated relationship across 6 orders of magnitude. The next generation of frontier models is targeting 100 to 1,000 times more compute than GPT-4 used, and no single hyperscaler can unilaterally stop scaling without falling behind competitively. So the capital expenditure cycle keeps accelerating by competitive necessity, not choice. Force 2. Software is eating the physical world. Sim-to-real transfer, training an AI model entirely in simulation, then deploying it onto a real robot, has collapsed the wall between digital AI and physical AI. LiDAR sensors that cost $75,000 in 2012 cost about $500 today. Foundation models trained on internet-scale data are now being adapted directly into robot motion control. Force 3. Demographic and labor economics. Working-age populations are shrinking across the United States, Europe, Japan, and China simultaneously, while Chinese manufacturing wages have risen roughly 5-fold since 2005. These 3 forces reinforce each other in a closed loop. Better AI produces better robots. Better robots demand more AI training, and that demands more compute, more energy, and more data center capacity. Now, the master framework before we go layer by layer. Let me anchor the scale with the numbers that define this moment. Hyperscaler capital expenditure in 2026, over $700 billion. Microsoft, roughly $190 billion. Amazon, around $200 billion. Alphabet, between $175 and $185 billion. Meta, $115 to $135 billion. Oracle, $50 billion through its Stargate joint venture with OpenAI. For historical context, the entire original internet build-out, Every fiber cable, every server farm, every backbone router from 1995 through 2005 cost approximately $500 billion over a full decade. This industry is spending more than that in a single calendar year, and consensus from major Wall Street research desk projects total spend crossing $1 trillion by 2027. Now the robotics numbers. The humanoid robot market today sits at roughly $4 to $6 billion, still tiny and largely pre-commercial, projected to reach $165 billion by 2034, a 50% compound annual growth rate sustained for 8 straight years. Goldman Sachs projects more than 1 million humanoid units shipped by 2030. NVIDIA's own estimated robotics addressable market by 2030, $50 billion and rising. And the number to sit with above all others, the global labor market is worth roughly $30 trillion annually. That is the prize humanoid robotics is ultimately chasing. Carry this framework through everything that follows. The infrastructure layer captures value regardless of which AI model wins the race. Now let's get physical about what all this compute actually consumes. Before naming a single energy company, internalize one number. A single large AI training cluster running 50,000 GPUs simultaneously consumes between 150 and 250 megawatts continuously. Not at peak continuously, every hour the training run is active. One NVIDIA H100 chip alone draws about 700 watts. Scale that across an entire hyperscaler's global footprint, and you're talking multiple gigawatts. United States data centers consumed roughly 200 terawatt-hours of electricity in 2023, about 4% of total national generation, and consensus projects that crossing 600 terawatt-hours by 2030, a tripling. Grid connection queues in Northern Virginia, the largest concentration of data centers on Earth, currently run 5 to 7 years long. And here is the constraint that pulls nuclear power into the center of this entire conversation. Hyperscalers have made binding net zero commitments to investors and regulators, so they cannot simply sign up for coal or unmitigated gas. Solar and wind are intermittent, and AI training needs power 24 hours a day, 7 days a week. The only carbon-free, always-on, scalable power source available today is nuclear. This is not an energy story that happens to intersect with AI. It is an AI story whose fundamental physical constraint is energy. Let's meet the companies that control that constraint. Layer 1 of the stack is energy, and it carries 5 names with very different risk profiles and very different time horizons. Constellation Energy and Vistra represent the existing, producing nuclear and diversified generation fleets, power that is already on the grid today, under long-term contract. GE Vernova represents the gas turbine backbone that gives every data center its dispatchable backup power. Oklo represents the speculative, pre-revenue frontier of small modular nuclear reactors. And EOS Energy represents a niche battery chemistry play for grid-scale storage. What unites all 5 is a single physical reality. AI cannot scale without reliable, clean, always-on electricity, and the companies that control that supply sit in a structurally advantaged position that will not change for decades. Let's walk through each one with precision. Constellation Energy operates the largest nuclear fleet in the United States. 21 plants, roughly 22 gigawatts of zero carbon, always-on capacity, already producing power today under contract with some of the most creditworthy companies on the planet. The mode is almost absurdly durable. A U.S. nuclear operating license takes 15 to 20 years to obtain and simply cannot be replicated at any price. The landmark deal is the 3 Mile Island Unit 1 restart, a 20-year power purchase agreement with Microsoft, and the $26.6 billion acquisition of Calpine adds gas backup for diversification. Contracted revenue backlog, approximately $460 billion. Vistra is the strong number 2. The largest competitive power generator in deregulated U.S. markets. More diversified, but more gas-heavy, running the largest corporate nuclear uprate program in American history and supplying Meta directly under multi-year power agreements. GE Vernova is the underappreciated industrial play, sole source supplier of the most efficient large gas turbines on Earth, over 50% U.S. market share, a backlog exceeding $44 billion driven specifically by data center demand, and a moat built on decades of metallurgical knowledge no competitor can shortcut. Oklo is the speculative end of the spectrum. Pre-revenue, co-founded by Sam Altman, with a meta deal for a 1.2 gigawatt Ohio campus and genuine NRC licensing progress. But its first commercial microreactor won't be online before 2027 at the earliest. EOS Energy makes zinc-based batteries for grid storage. No lithium, no fire risk, but remains small revenue, unprofitable, and a watch-and-see position until it proves manufacturing scale. The layer winner is Constellation Energy by a wide margin. Let me give you the quick-fire picks. Quick picks for the energy layer. The core holding, Constellation Energy, irreplaceable licensed nuclear capacity, the most creditworthy customer base in the market, and $460 billion of contracted backlog. The strong complement. Vistra, for diversified generation exposure with real nuclear upside, accepting more leverage and more gas price sensitivity in return. The industrial sleeper. GE Vernova, for pure exposure to the gas turbine bottleneck without touching nuclear regulatory risk at all. The speculative option, Oklo, sized as a long-duration call option on small modular reactors actually working commercially, not as a core position. And the watchlist name, EOS Energy, worth tracking for manufacturing proof points before committing real capital. Across all five, the read-through is the same. Power is the binding constraint of this entire decade, and these are the companies that own it. That is energy, the layer everything else in this stack is built on top of. No electrons, no inteligência artificial. Now let's go up one level into the silicon that turns those electrons into intelligence. Before naming a single chip company, anchor the scale of what's already happened. NVIDIA's fiscal 2026 data center revenue, roughly $193.7 billion. Total company revenue around $215.9 billion, up 65% year over year, with next quarter guidance implying an annualized run rate approaching $312 billion. A single fabless chip designer generating over $200 billion in a year would have sounded impossible 18 months ago. Now it's the baseline. Semiconductors are not one industry. They're 5 distinct sub-industries with very different moat structures. Electronic design automation software, where Synopsys and Cadence have a multi-decade duopoly on the tools every chip designer uses. Specialty materials and gases, where ultra-pure neon and argon require decade-long supplier qualification. Lithography, where ASML holds an absolute monopoly on the machines that print the most advanced chips. Foundry manufacturing, where TSMC's process leadership is the single most important physical choke point in the entire AI supply chain. And memory, where SK Hynix and Micron's high-bandwidth memory is physically embedded inside every frontier AI chip. With that map in mind, here are the 5 tickers that matter most. NVIDIA's moat starts with CUDA, the software platform released back in 2006. 19 years of accumulated code, tooling, and professional training means switching from NVIDIA to a competitor isn't a hardware decision. It's a 1 to 2 year, tens of millions of dollars workforce retraining decision that almost nobody attempts. Add full-stack vertical integration, servers, networking, simulation software, and now robotics foundation models. And NVIDIA isn't really a chip company anymore. It's the AI operating system. Real risks exist. Roughly $15 to $16 billion in annual revenue loss to China export restrictions, hyperscaler custom silicon chipping away at specific inference workloads, and a valuation near $3.3 trillion that prices in continued dominance. TSMC is the toll booth nobody can route around. Every advanced logic chip from NVIDIA, Apple, AMD, and Google's own custom silicon is manufactured there, on process knowledge accumulated over more than 20 years that Intel has spent $45 billion trying and failing to match. Micron is the hidden gem. Its high-bandwidth memory sits physically inside every NVIDIA Blackwell GPU. It's the only US-based DRAM maker, and its next quarter guidance points to roughly $33.5 billion in revenue and 81% gross margin. software-level economics from a historically commodity business. AMD doesn't need to beat NVIDIA. Just capture share in a market worth $200 billion and growing. Its OpenAI partnership for 6 gigawatts of deployment and 34% revenue growth last quarter both validate that thesis, with its ROCm software ecosystem still the gap to close. ARM Holdings collects a royalty on nearly every chip architecture on Earth, including the management cores inside NVIDIA's own GPUs, giving it durable, if less explosive, exposure as AI expands to edge devices and robots. The layer winner, NVIDIA, by a moat that deepens every single year. Quick picks for chips and computing. The core position, NVIDIA, the undisputed layer winner, accepting a premium valuation for an unmatched moat. The structural hedge, TSMC, because literally nothing in this entire sector ships without it. The hidden value play, Micron, for high bandwidth memory exposure, most investors still price as a commodity cyclical rather than a strategic AI supplier. The credible challenger, AMD, for investors who want upside if custom silicon and second source dynamics accelerate. And the durable royalty stream, ARM Holdings, for diversified, low volatility exposure to every chip shipped, AI-related or not. We will come back to NVIDIA in much greater depth in a moment, but first, the full layer synthesis. Pulling the 5 sub-industries and 5 companies together. Design tools, materials, lithography, foundry, and memory all funnel upward into a single choke point structure where a handful of companies capture the overwhelming share of economic value. NVIDIA sits at the top of that structure with roughly 80% share of AI accelerators, a number eroding more slowly than bears predicted as custom hyperscaler silicon remains non-general purpose by design. TSMC sits underneath as the manufacturing gate nobody can bypass. Micron sits inside every Blackwell GPU as a literal physical component, not just a supplier. The single most important monitoring metric for this entire layer, and arguably this entire report, is whether cloud revenue growth at the major hyperscalers sustains above 20%. If it does, the capital expenditure flywheel keeps turning. If it falls below 15% for 2 consecutive quarters, this entire thesis needs re-examination. Layer winner, confirmed, NVIDIA. Now, because no single company in this stack matters more, let's spend a dedicated section going deeper on it specifically. NVIDIA, ticker NVDA, is not a chip company. It is the operating system of the AI era, and understanding precisely why is worth a few extra minutes. CUDA's moat is a developer ecosystem moat, not a hardware moat. Every deep learning researcher for 19 straight years has written code in CUDA, alongside its surrounding libraries for deep neural networks, linear algebra, and multi-GPU communication, plus deep optimization inside PyTorch and TensorFlow. Migrating away means rewriting software, retraining engineers, and rebuilding workflows, a cost no performance advantage from a rival chip currently justifies. On top of that software layer sits full vertical integration, complete DGX server systems, Mellanox InfiniBand networking fabric that links thousands of GPUs into one training cluster, and now GR00T, NVIDIA's foundation model for robots, alongside its Isaac simulation platform and Cosmos world simulation environment. Every layer reinforces every other layer. The numbers, roughly $193.7 billion in fiscal 2026 data center revenue. Total revenue, near $215.9 billion, up 65% year over year, with the next architecture generation, Vera Rubin, already sampling with customers to keep the cadence going. The honest risks. Chinese export restrictions costing $15 to $16 billion annually in foregone sales. Hyperscaler custom silicon nibbling at predictable inference workloads. GPU spot rental rates down 60 to 75% from their 2023 peak, and a market capitalization near $3.3 trillion trading at roughly 60 times forward earnings. A valuation that prices continued dominance, not business quality, as the real risk. Now, up to the layer where that silicon actually gets deployed at scale, cloud and data centers. Cloud and data centers contain 3 business models investors routinely conflate, and confusing them leads to real analytical errors. Model 1. Full hyperscalers like AWS, Azure, and Google Cloud, vertically integrated, designing their own chips, running their own software platforms, with switching costs so high that migrating an enterprise AI stack is a multi-year project. Model 2, GPU cloud operators, often called neoclouds, who rent bare metal GPU capacity to AI labs needing compute faster than hyperscalers can provision it. The moat here is speed of deployment and GPU allocation relationships with NVIDIA itself. Model 3, co-location and data center real estate, where the moat is simply location. A carrier-neutral facility cannot be built next door overnight. This section focuses on the neocloud operators specifically because that is where the most interesting and, frankly, the most leveraged opportunities in this layer currently sit. CoreWeave's position is extraordinary on the surface. Over $55 billion in contracted backlog, more than 250,000 GPUs across 32 data centers. OpenAI committed $22.4 billion, Meta signed $14.2 billion, and NVIDIA itself invested $2 billion directly. But the risk side is equally real, a debt-to-equity ratio of 4.8 times, $34 billion in off-balance sheet lease obligations, and roughly 70% of revenue concentrated in just 2 customers. Nebius Group is the most misunderstood name in the peer group, emerging from Yandex's engineering talent, but now headquartered in Amsterdam with a clean balance sheet. $1.8 billion in cash and only 0.3 times debt to equity, making it the only neocloud that could absorb a real demand slowdown without covenant stress. Iris Energy pivoted from Bitcoin mining to AI cloud and owns its own hydroelectric power in Canada, a structural cost advantage, with Microsoft as its primary tenant. Applied Digital doesn't run GPUs at all. It owns the data center real estate that operators like CoreWeave lease, anchored by an $11 billion 15-year contract. Cipher Mining is the smallest, highest beta name, still partly Bitcoin distracted, but carrying real institutional backing from Google-affiliated and AWS-linked contracts. The layer winner on scale is CoreWeave, the best risk-adjusted alternative, carrying the same strategic exposure with a dramatically cleaner balance sheet, is Nebius. Quick picks for cloud and data centers. The scale leader, CoreWeave, for investors comfortable underwriting leverage in exchange for the dominant backlog and the best-named customer list in the neocloud space. The risk-adjusted alternative, Nebius, for nearly identical demand exposure with a balance sheet that can actually survive a downturn. The owned infrastructure angle, Iris Energy, for investors who want a structural power cost advantage layered on top of the AI cloud thesis. The real estate angle, Applied Digital, for long duration, contracted lease income rather than direct GPU economics. And the speculative small cap, Cipher Mining, sized appropriately small given its scale and lingering crypto exposure. Now, let's pull the layer together. The cloud and data center layer is, in many ways, a leverage story disguised as a growth story. Every operator here is racing to build capacity ahead of demand, financed with debt, lease obligations, or both, betting that hyperscaler and AI lab tenants keep paying premium rates for capacity that is currently sold out. CoreWeave wins on absolute scale and backlog quality. Nebius wins on financial resilience. Iris Energy wins on own power cost. Applied Digital wins on contracted real estate duration. Cipher Mining is the high beta call option on the whole category re-rating. The layer winner remains CoreWeave, with Nebius as the name most likely to be underpriced relative to its actual risk. From the buildings that house the compute, we move up to the intelligence running inside them, the hyperscalers fighting the AI model war. 5 companies, a combined $690 billion in 2026 capital expenditure, and a single defining strategic question: which hyperscaler combines the best frontier AI capability, the widest distribution, and the strongest monetization engine? This is the layer where the headlines live, model releases, benchmark wars, chatbot comparisons. But the actual investment case rests less on which model is smartest this quarter and more on which company can turn AI capability into recurring, durable revenue across an enterprise customer base it already owns. Before the company-by-company analysis, it's worth understanding what's physically happening inside the training clusters these companies are building. A modern AI training cluster requires 100,000 GPUs or more, and each one needs to communicate with every other GPU constantly, at extremely high speed and extremely low latency, during the synchronization steps fundamental to distributed training. That traffic currently runs at 400 to 800 gigabits per second per connection, climbing to 1.6 terabits per second within roughly 18 months. Powering and cooling that cluster is its own physical challenge. A single rack of 72 next-generation GPUs draws around 120 kilowatts versus 10 to 15 kilowatts for a traditional server rack, and the laws of thermodynamics make air cooling physically impossible at that density. Liquid cooling isn't a preference, it's mandated by physics. We'll return to the specific companies that build this networking and cooling infrastructure later in the supplementary layers. For now, understand that every dollar of model layer capital expenditure is, underneath the surface, also a bet on this physical architecture working at scale. With that grounding, let's meet the 5 hyperscalers actually running this race. Microsoft's position is the most defensible because it controls both the frontier model through its OpenAI partnership and the distribution channel to more than 350 million Microsoft 365 enterprise users. Charging roughly $30 per user per month to embed Copilot into Word, Excel, and Teams isn't really selling AI. It's selling deeper lock-in to an ecosystem enterprises already depend on. AI annual recurring revenue hit roughly $13 billion in 2025, up 175%. With Azure growing 39%. Alphabet is the only hyperscaler that can run the entire stack end-to-end without external dependency. Its own DeepMind models, its own custom TPU chips, its own cloud, and the world's largest text and video training datasets through Search and YouTube. Google Cloud is growing 48%, the fastest of any major cloud platform, with a contracted backlog that has doubled year over year to roughly $460 billion. Meta's strategy is counterintuitive. It gives away its Llama models as open source because its actual monetization is advertising, not AI subscriptions, and a smarter ad targeting engine built on 3.3 billion daily users' behavioral data is worth far more to Meta than API revenue would be. Amazon runs the largest cloud platform by revenue, around $37.6 billion quarterly, but takes a deliberately neutral, multi-model approach through Bedrock rather than betting on a single frontier model of its own, a pragmatic stance that could become a strategic gap if the model layer becomes the primary battleground. Oracle is the surprise entrant, a legacy database company that became critical infrastructure for OpenAI's training operations through the Stargate joint venture, committing $500 billion alongside SoftBank. The layer winner is Microsoft on the combination of model access and distribution scale. Closest challenger is Alphabet on vertical integration depth. Quick picks for AI models. The core position. Microsoft for the combination of frontier model access through OpenAI and the deepest enterprise distribution moat in the sector. The vertical integration play. Alphabet for investors who want exposure to a company that owns every layer of its own stack with no external dependency. The contrarian bet. Meta for those convinced that open-source model commoditization, paired with the best advertising data on Earth, is a more durable monetization path. The scale but neutral pick, Amazon, for AWS sheer cloud market share, accepting that it lacks a frontier model of its own. And the dark horse, Oracle, a high-conviction, high-debt bet on the OpenAI relationship and Stargate actually executing. From the model layer, let's move to where AI revenue ultimately gets collected, the applications running on top of all of this. Stepping back across this layer, every one of these 5 companies is making a different strategic bet on how AI gets monetized. Microsoft through enterprise software lock-in, Alphabet through full-stack vertical control, Meta through advertising and open-source commoditization, Amazon through neutral infrastructure, Oracle through a single, concentrated, high-conviction partnership. None of these bets are mutually exclusive at the macro level. Combined capital expenditure across all 5 exceeds $690 billion in 2026 alone, and all 5 need the chip and energy layers below them to succeed simultaneously. The layer winner remains Microsoft. Now up one final level in the core stack, to where this all becomes a product someone actually pays for. The applications layer is the least mature of the 5 core layers, and also the most forward-looking. Infrastructure spending is real today. Model training is real today. But translating raw AI capability into measurable enterprise productivity gains, and then charging for those gains, is still early innings for most software categories. There is one clear exception, and the data behind it is extraordinary enough to lead with before anything else. Palantir's most recent quarter, revenue of roughly $1.633 billion, up 85% year-over-year, the highest growth rate in the company's public history, with U.S. commercial revenue up 133% and a Rule of 40 score of 145%, a level matched in software, by management's own comparison, only by NVIDIA, Micron, and SK Hynix. Full-year guidance was raised to roughly $7.65 billion, the largest single guidance raise in company history. The product behind those numbers, AIP, isn't a chatbot. It's an ontology-based framework that grounds large language models in an enterprise's actual operational data, which is precisely why institutions like the U.S. Army trust it with a $10 billion contract for real decision-making rather than just analytics. Tesla sits in this layer as the physical AI wildcard, simultaneously chasing humanoid robots through Optimus, autonomous driving through full self-driving, and its own AI training infrastructure through the Dojo and Cortex clusters. We'll dig into Tesla properly in the robotics section. ServiceNow is embedded in 85% of Fortune 500 IT workflows, with its Now Assist AI product driving guidance up to roughly $4.45 billion at 28% growth. Snowflake is becoming the data backbone every enterprise AI application needs to query against, with its Cortex AI platform gaining real traction. Salesforce, the largest enterprise SaaS company by revenue, has signed more than 5,000 customers onto its Agentforce autonomous agent platform in its first quarter of availability alone. The applications layer winner is Palantir, with Tesla as the physical AI wildcard worth watching most closely. Quick picks for applications. The core conviction name, Palantir, for the clearest proof that enterprise AI monetization is real today, not promised for some future quarter, accepting a valuation that prices in near-flawless execution. The wildcard, Tesla, for asymmetric upside if Optimus and full self-driving both progress on anything close to their stated timelines, with real execution risk priced against that upside. The workflow compounder, ServiceNow, for deep, sticky enterprise penetration that AI is reinforcing rather than threatening. The data infrastructure pick, Snowflake, for consumption-based growth that scales automatically as AI applications use more enterprise data. And the platform pivot, Salesforce, for investors betting that Agentforce re-accelerates growth that has otherwise moderated into the low teens. Let's tie the layer together before heading into robotics properly. What ties Palantir and Tesla together in this layer, despite looking like completely different businesses, is that both are converting frontier AI capability into trusted, operational, real-world decisions. Palantir in enterprise and defense workflows, Tesla in physical movement and driving. That convergence is exactly the bridge into the next major section of this report. Applications are where AI value crystallizes into revenue someone actually pays. Robotics is where that same intelligence crystallizes into physical action. They are not separate stories. They're the same story, viewed from two different angles. Before we go deep on robotics as its own sector, let's spend a dedicated profile on the company that has already proven this thesis most convincingly. Palantir, ticker PLTR, deserves its own profile because no other enterprise software company has solved the specific problem it solves, deploying frontier AI on proprietary, sensitive data in a way that institutions trust enough to act on. AIP, the Artificial Intelligence Platform, is not a general-purpose chatbot. It's an ontology layer that gives large language models a structured, grounded relationship with an organization's actual systems of record, which prevents the kind of plausible but wrong output that makes general AI unsuitable for load-bearing decisions. For the U.S. Army running battlefield logistics, or an insurer processing claims. The difference between AI that's correct 95% of the time and AI correct 99.9% of the time is enormous. And AIP is built specifically for that higher bar. The numbers back the claim. Revenue up 85% year over year to roughly $1.633 billion. U.S. commercial revenue up 133%. GAAP net income of $870.5 million and a Rule of 40 score of 145%. The $10 billion U.S. Army Titan contract isn't just revenue. It's proof the Department of Defense trusts this platform with its most sensitive operational decisions, a credential no purely commercial competitor can replicate. The honest risk is entirely in the valuation. At over 80 times trailing revenue, there's essentially no room for execution error, and any deceleration in U.S. commercial growth would trigger significant multiple compression. The market is pricing perfection. As of the most recent quarter, Palantir is delivering it. Now, the section I want to spend real time on, robotics, the physical AI frontier. Robotics is where the gap between narrative and operational reality is wider than in any other category in this report. So let's start with an honest taxonomy. Industrial robots. The six-axis arms from ABB, Fanuc, Yaskawa, and Kuka that have worked factory floors for 40 years represent a mature, roughly $17.9 billion market, growing steadily to about $33 billion by 2035, augmented by AI vision rather than disrupted by it. Warehouse and logistics robots, led by Amazon Robotics and Symbotic, are the fastest-growing category by deployed units today. Humanoid robots, Tesla, Figure AI, Boston Dynamics, Agility Robotics, get all the attention and remain the earliest stage category, under $1 billion in market size today, projected by Goldman Sachs to reach $38 billion by 2035. Autonomous vehicles, led by Waymo at over 250,000 weekly rides across 5 U.S. cities, represent the most commercially proven physical AI deployment at scale on Earth today. And surgical robotics, dominated by Intuitive Surgical at over $10 billion in annual revenue, is the clearest evidence of what a mature, profitable physical AI business actually looks like once it gets there. Let's get the quick picks out of the way before going deep. Here is which stack companies actually win as physical AI scales, regardless of which specific humanoid brand ultimately leads. NVIDIA wins again here through its GR00T robot foundation model, Jetson Edge Compute, and Isaac simulation platform. The same moat that wins in digital AI extends directly into physical AI. ARM Holdings wins through royalties on the processor architecture inside nearly every robot built. Tesla is the highest conviction single bet on vertically integrated physical AI, leveraging more than 1 billion miles of real-world driving data. Micron wins wherever AI is deployed, cloud, or edge, because every robot needs memory and storage. Palantir is already powering autonomous defense and logistics platforms today, not someday. And Constellation and Vistra matter here too. Robot charging infrastructure needs the same 24/7 clean power as data centers, so the energy layer is just as relevant to physical AI as it is to digital AI. Now, the state of the humanoid race itself. As of today, not the press release version. Boston Dynamics achieved something genuinely significant. Its all-electric Atlas robot moved into confirmed commercial production, with tens of thousands of units committed for deployment inside Hyundai manufacturing facilities and a 30,000 unit per year factory commitment behind it, making Boston Dynamics the first humanoid company to reach commercial production at scale, not a pilot. Tesla's Optimus remains the narrative leader and, so far, the execution laggard. Promised deliveries of 5 to 10,000 internal units by the end of 2025 did not materialize, with 0 external deliveries to date, though Tesla is now converting Fremont factory capacity toward internal deployment in 2026. Figure AI, privately valued near $39 billion, is arguably the most technically credible startup, having demonstrated dexterous manipulation at a BMW facility that exceeded any other commercial humanoid deployment, backed by OpenAI's foundation model research, though it carries 0 commercial revenue at scale against that valuation. Agility Robotics Digit is purpose-built for logistics rather than general labor, already tested inside Amazon warehouses. And then there is Unitree's G1, commercially available today, shipping to North America, priced at roughly $16,000. The quality gap versus Boston Dynamics or figure is real, but if you track the Chinese EV cost curve from 2019 to 2024, you already know exactly why this number matters, and why it represents a structural risk to every Western humanoid valuation built on much higher price points. Now, the hardware bottlenecks almost nobody is discussing. Intuitive Surgical is the clearest proof of concept for where the entire robotics investment thesis eventually lands, and it's been hiding in plain sight the whole time. Over $10 billion in annual revenue, more than 10,700 Da Vinci systems installed worldwide, 3.1 million procedures performed in 2025 alone, and 20 million lifetime procedures crossed. The business model is the classic razor and blade structure. Each Da Vinci system sells for $1 to $2 million plus. But the real revenue engine is the proprietary, disposable instruments used in every single procedure, $700 to $2,000 each, automatically repurchased every time a surgeon operates, accounting for around 60% of total revenue. 25 years of clinical evidence, surgeon training programs that create genuine professional switching costs, and hospital procurement relationships that take years to establish all combined into a monopoly. Competitors like Medtronic's Hugo system and Stryker's Mako have not been able to seriously challenge. Intuitive Surgical is not the most exciting AI story in this report. It is the most mature one, and the clearest evidence that physical AI, once it reaches commercial maturity, produces genuinely extraordinary economics. Now, the full ecosystem map of every other humanoid player in the field. Beyond the names already covered, the broader humanoid field includes Agibot in China, running automotive pilots backed by major Chinese venture capital with a 1,000-unit batch announced, and Aptronic's Apollo, partnered directly with Google DeepMind's Gemini robotics program and collaborating with NASA. Altogether, somewhere between 30 and 50 active humanoid companies are operating globally right now, at wildly different stages of technical maturity and commercial readiness. Behind all of them sits the much older, much larger industrial robot backdrop. ABB, Fanuc, Yaskawa, and Kuka, a $17.9 billion market today, growing to roughly $33 billion by 2035, where the mode is reliability and decades-long customer relationships on 25-year replacement cycles, not cutting-edge AI. The humanoid race gets the headlines, but the industrial robot base is the financial bedrock the entire physical AI thesis is being built on top of. Now, the full hardware and software ecosystem framework underneath every one of these companies. Every humanoid robot, regardless of brand, depends on the same 5 hardware subsystems and the same emerging software stack. On hardware, actuators that act as the muscles, sensors that act as the nervous system, onboard compute that acts as the brain, and a power system that acts as the metabolism, each with its own supplier concentration and its own bottleneck, which we'll detail next. On software, simulation platforms where robot models train millions of times in virtual environments before ever touching a physical body, foundation models that translate internet-scale intelligence into physical motion planning, and a brewing platform war over who controls the operating system robots actually run on. NVIDIA Isaac pursuing hardware-level dominance. Google's Gemini Robotics pursuing model-level dominance. OpenAI backing Figure AI, and Tesla building every layer itself. Vertically, whoever wins that platform war effectively captures a royalty on every robot built going forward, the same way iOS and Android capture a toll on every smartphone shipped. Let's name the specific companies that went across this ecosystem. Across application verticals, the winners and their moats look distinct depending on which problem is actually being solved. In warehousing and logistics, Amazon Robotics and Symbotic win on deployed scale and proven AI-optimized storage, already running live inside Walmart facilities. In general manufacturing, established industrial players win on reliability and switching cost, not novelty. In general-purpose humanoid labor, the race is genuinely open, and the deciding factor is not the most impressive demo video. It's whichever company gets cost per unit down to roughly $20,000 first, the threshold at which a humanoid's 2-year labor payback period actually becomes economically rational versus a roughly $100,000 to $150,000 price tag today. On the platform layer specifically, NVIDIA already counts more than 40 humanoid robotics partners using Isaac, Google's Gemini Robotics as Boston Dynamics, Agility, and Enchanted Tools as partners, and Tesla's bet is that full vertical integration beats any platform alliance. The investment read-through. In an immature category, bet on the platform and supply chain layers that win regardless of which specific robot brand ultimately leads, rather than betting on a single humanoid company's demo footage. Now, the specific physical choke points that determine who can actually scale. This is the section most robotics coverage skips entirely, and it's the most important one for understanding real scaling risk. Actuators, the muscles. Harmonic drive gearboxes convert motor rotation into precise joint movement. And two Japanese companies, Harmonic Drive Systems and Nabtesco, control roughly 70% and 30% of global market share respectively, protected by patents and 50 years of manufacturing precision with no viable Western or Chinese alternative at the quality level top humanoid programs require. That concentration creates a genuine single point of failure. A major earthquake in the relevant Japanese manufacturing regions would not slow the global humanoid industry. It would halt it. Sensors, the nervous system. LiDAR costs collapse from $75,000 to roughly $500 over 12 years. But tactile sensing, the ability for a robotic hand to feel and manipulate arbitrary objects, remains too slow, too fragile, and too expensive at scale, making it the single most important near-term technical bottleneck in the entire field. Onboard compute, the brain. NVIDIA's Jetson Orin dominates edge AI compute for robotics, where real-time motor control inference must happen in under 10 milliseconds. Power, the metabolism. Current humanoid batteries provide only 2 to 4 hours of operation, and a robot needing a recharge every 2 hours cannot genuinely replace a human working an 8-hour shift. Solid-state battery technology, which could roughly double or triple energy density, is not expected at production volume until 2028 or later. Until that changes, humanoids remain fundamentally limited to applications where frequent recharging is operationally acceptable. Now, the company that is making the single largest, most concentrated bet on all of this working out. Tesla, ticker TSL, is not really a car company anymore. It is the only organization in the Western Hemisphere simultaneously building humanoid robots, autonomous vehicles, and dedicated AI training infrastructure at meaningful scale all at once. On Optimus, the Gen 2 robot demonstrated dexterous object handling with a 22 degree of freedom hand. Internal factory deployment is underway, and Fremont capacity is being converted toward production in 2026, with a long-term target price of $20,000 to $30,000 per unit versus over $100,000 for Figure AI and roughly $140,000 for Boston Dynamics Atlas. That cost target is the entire competitive thesis if Tesla actually gets there. On full self-driving, version 13 and beyond runs an end-to-end neural network with no reliance on high-definition maps. The Cybercab launched in limited scale in Austin, but Waymo still leads the category outright at over 250,000 weekly rides across 5 cities, and FSD itself remains classified as SAE Level 2 in most jurisdictions, with a May 2026 Reuters investigation raising real questions about how its safety statistics are calculated. The genuine differentiator behind both programs is data. Roughly 4 million full self-driving equipped vehicles generating real-world driving data at a volume no competitor can match, with the same underlying neural network architecture being adapted for Optimus, a transfer of capability that is plausible but not yet proven. The honest framing, straight from the source material itself. If Optimus and full self-driving both succeed on anything close to their stated timelines, Tesla is worth multiples of its current value. If either slips by 2 or more years, the current valuation requires the other program to succeed completely on its own. This is a binary bet on physical AI, the highest risk, highest upside position discussed anywhere in this report. Now, let's zoom back out and rank every company across every layer at once, pulling every layer together into one ranking. Top tier, the clearest 5-star conviction calls. NVIDIA, the defining company of the AI decade with a 19-year moat that compounds rather than erodes. And Microsoft, the best enterprise AI distribution engine on Earth through OpenAI exclusivity and Copilot's reach. 4-star tier, Alphabet for vertical integration depth, TSMC as the irreplaceable manufacturing choke point, Constellation Energy for its irreplaceable nuclear licensing mode, and Micron for HBM sitting physically inside every frontier chip. 3-star tier, Palantir extraordinary growth offset by an extraordinary valuation, CoreWeave, dominant scale offset by real leverage, Meta, the open source bet plus the best advertising data on Earth, and Amazon, the largest cloud business without a frontier model of its own. By layer, energy belongs to Constellation, chips to NVIDIA, cloud to CoreWeave, models to Microsoft, and applications to Palantir, with Tesla as the physical AI wildcard threaded through all of it. That's the core stack, fully ranked. Now, the 5 layers most coverage of this sector leaves out entirely, and some of them matter more than people realize. 5 categories are either entirely absent or badly underrepresented in most AI infrastructure coverage, and none of them are minor omissions. AI networking and interconnect, because thousands of GPUs are worthless if they can't talk to each other fast enough. Server and OEM assembly, because a chip is not a system, and somebody has to actually build the box around it. Power management and cooling inside the data center, because the physics of a 120 kilowatt rack genuinely cannot be ignored. NAND storage, because every training run and every inference query needs somewhere fast to read and write data. And small modular nuclear reactors as their own distinct investable category, separate from the large utility scale nuclear names already covered. 10 new companies, 5 new layers. Let's complete the stack, starting with the wires. Most investors think about GPUs when they think about AI clusters and stop there. But a single GPU sitting alone in a server cannot train a meaningful model. You need tens or hundreds of thousands of them working together, constantly synchronizing at extremely high bandwidth and extremely low latency. That communication runs at 400 to 800 gigabits per second per port today, scaling toward 1.6 terabits per second within roughly 18 months. The switches that route that traffic, the custom chips that process the packets, and the optical transceivers that convert electrical signals to light. Together, this is a market worth more than $50 billion by 2028 and one the original wave of AI infrastructure coverage almost entirely ignored. Quick picks for AI networking. The core position, Broadcom, for its custom chip co-design relationships with 3 of the 5 largest hyperscalers, generating over $12 billion in annualized revenue, combined with dominant switching silicon found in the spine of nearly every AI data center on Earth. The pure-play alternative, Arista Networks for its software-defined operating system running the cluster spines at Meta, Microsoft, and Amazon, and its leading position in the push toward open Ethernet standards as an InfiniBand alternative. The connectivity specialist, Marvell Technology, for its custom silicon roll inside Amazon's Trainium chips and Google's TPU connectivity layer. And the high-risk, high-reward bet, Astra Labs for its sole source position inside NVIDIA's flagship rack architecture. Let's go a layer deeper on each. Broadcom's custom application-specific chip business, designing bespoke AI accelerators for Google, Meta, and ByteDance under confidential agreements, now generates over $12 billion annualized at very high margins, and its Tomahawk switching silicon supports over 50 terabits per second of aggregate capacity. Arista built EOS, its switching operating system, with roughly 20 years of accumulated switching cost and a command line interface network engineers genuinely prefer, and as co-founder of the Ultra Ethernet Consortium, Arista stands to benefit directly if Ethernet displaces NVIDIA's proprietary InfiniBand at scale. An outcome made more likely by the simple economics that an InfiniBand fabric costs roughly 1.5 to 2 times an equivalent Ethernet fabric. Marvell's custom silicon now drives roughly 55% of total revenue, anchored by a multi-year Amazon Trainium co-development program. Though Amazon concentration at around 40% of revenue is the clear risk to watch. Astra Labs makes the connectivity chips that are sole source inside NVIDIA's flagship GB200 rack architecture, growing revenue over 60% with gross margins approaching 80%, an unusually strong competitive position for a company this size. The layer winner is Broadcom, with Arista as the strongest pure networking alternative. Now, the physical box and the thermal system around all of this silicon. When NVIDIA ships a GPU, it ships silicon on a circuit board. That board still needs a server chassis, a power supply, a cooling system, internal networking, storage, and firmware before it can actually run anything. And somebody has to integrate all of that. Separately, the power and cooling layer inside the data center faces a single defining number: 120 kilowatts, the draw of a single next-generation GPU rack, versus 10 to 15 kilowatts for a traditional server rack. The electrical distribution systems, backup power units, and liquid cooling infrastructure required to handle that load represent a market worth more than $40 billion, growing over 20% annually. Supermicro is the fastest-growing server OEM, first to market on every new NVIDIA rack design, though it carries a real governance discount after a 2024 accounting restatement and a Department of Justice investigation that ultimately closed without charges. High reward, elevated risk, not a position for conservative investors. Dell Technologies is the opposite profile. Diversified investment grade, with over 100,000 enterprise relationships and an AI server backlog exceeding $9 billion. Less exciting on pure growth, far more bankable. On the physical side, air cooling's theoretical maximum at data center scale is roughly 50 kilowatts per rack, while modern AI rack draws 120. The laws of thermodynamics make liquid cooling mandatory, not optional, and Vertiv makes those systems, with order growth exceeding 25% and backlogs extending 18 months because it simply cannot build product fast enough. Eaton Corporation, a century-old industrial conglomerate, makes the medium-voltage switchgear that steps utility power down for data center distribution, with a record $13 billion order backlog and investment-grade balance sheet. The defensive pick for investors who want AI infrastructure exposure without the volatility. The winners: Supermicro on growth with the governance caveat explicitly noted, Dell as the conservative alternative, Vertiv on thermal physics, Eaton as the defensive power distribution complement. Now storage. Training a large language model means processing tens of terabytes of raw text data. And before a single GPU touches that data, it lives on solid-state drives being read continuously at hundreds of gigabytes per second for weeks. On the inference side, as context windows expand from a few thousand tokens toward a million, the memory cache every AI query generates grows right alongside it. And storing the cache on fast local storage is the difference between a usable AI application and a frustrating one. SanDisk, spun out as a pure-play NAND company, is the cleanest bet on this structural demand, with newer three-dimensional NAND optimized specifically for the read-heavy workloads AI inference creates. Western Digital retains the hard drive business alongside its NAND stake, and that hard drive business is re-accelerating because AI training requires enormous, cost-efficient cold storage for raw training data and archival footage, a more defensive, diversified position than pure NAND exposure. Worth a brief mention alongside storage. ASML, based in the Netherlands, hold an absolute monopoly on the extreme ultraviolet lithography machines required to print the most advanced chips on Earth, producing at most around 60 units a year due to sheer physical complexity. A choke point so tight that export restrictions to China effectively extend TSMC's manufacturing lead by denying competitors access to the one tool that makes leading-edge chips possible at all. The storage layer winner is SanDisk, with Western Digital as the diversified runner-up. Now, the final supplementary layer, nuclear power, at a much smaller scale than the utility giants covered earlier. The physics case for small modular reactors is straightforward. A hyperscale data center campus at full build consumes between 500 and 1,000 megawatts continuously. A conventional nuclear plant costs $10 to $20 billion and takes 15 years to build, while small modular reactor outputs 50 to 300 megawatts, costs $1 to $3 billion, and can be built in 3 to 5 years from factory-produced modules. Economics that align almost perfectly with data center campus sizing, and that eliminate the grid connection queue entirely by sitting on site. NuScale Power holds the only design with full regulatory approval from the Nuclear Regulatory Commission in the United States, a process that takes over a decade and hundreds of millions of dollars to complete, meaning any new entrant has to repeat that entire decade of work from scratch, a genuine regulatory moat. Its VOY GR12 design, combining 12 reactor modules into roughly 924 megawatts of combined output, already carries more than 20 letters of intent globally, with active evaluation specifically for data center colocation. BWX Technologies has manufactured nuclear components for the U.S. Navy for over 50 years, building the propulsion systems inside every American submarine and aircraft carrier, and stands as the picks and shovels play if small modular reactors commercialize at scale, supplying the fuel and reactor components other operators will need. With security clearances and a nuclear safety culture new entrants cannot replicate quickly. The winner here is NuScale Power, on the strength of its regulatory head start alone, with BWX Technologies as the diversified infrastructure complement. That completes every individual layer. Now let's see the whole map at once. With the supplementary layers added, the complete investable AI supply chain spans 10 layers. Energy generation, Constellation, Vistra, GE, Vernova, EOS. Small nuclear, Oklo, NuScale, BWX Technologies. In data center power and cooling, Vertiv, Eaton. AI networking and interconnect, Broadcom, Arista, Marvell, Astrolabs. Logic chips, NVIDIA, AMD, TSMC, ARM memory and storage. Micron, SanDisk, Western Digital. Server and OEM assembly, Supermicro, Dell. Cloud and data centers, CoreWeave, Nebius, Iris Energy, Applied Digital, Cipher Mining. AI models and hyperscalers, Microsoft, Alphabet, Meta, Amazon, Oracle. And applications and robotics, Palantir, Tesla, ServiceNow, Snowflake, Salesforce, and Intuitive Surgical. Group them conceptually and the picture clarifies fast. The bottom layers, energy and silicon, are today's binding physical constraints. The middle layers, hardware systems and cloud, are where the capital expenditure is actually flowing right now. The top layers, intelligence and applications, are where return on investment eventually gets extracted. And robotics cuts across all of it, converging every hardware and software supply chain into physical machines. That is the complete map. Now, the verdicts most investors get wrong. Layer by layer, the declared winners. Energy goes to Constellation, small nuclear to NuScale, power and cooling to Vertiv, networking to Broadcom, logic chips to NVIDIA, memory and storage to Micron, server assembly to Supermicro with its governance caveat noted, cloud to CoreWeave, AI models to Microsoft, and applications and robotics to Palantir. But three specific calls deserve extra emphasis because the market still underprices them relative to the underlying business. GE Vernova is underappreciated. Over 50% U.S. gas turbine market share, a $44 billion backlog, and most investors haven't even connected it to the AI theme yet. Nebius Group is undervalued. The same strategic neo-cloud exposure as CoreWeave, with a dramatically cleaner balance sheet, trading at a fraction of the valuation. And Micron is underestimated. High bandwidth memory sitting physically inside every frontier chip. The only US-based DRAM maker, generating 81% gross margins that most equity analysts are still pricing as if this were a commodity cyclical business. Those are the three names worth rereading if you skimmed past them earlier. Now, before the overall ranking, the part of this report that matters just as much as the winners, the risks. Everything up to this point has been the bull case, built honestly, layer by layer. What follows is the other half of the analysis, the specific structural risks that could derail this thesis, the rankings that weigh both sides against each other, and a framework for monitoring whether any of this is actually playing out the way the bulls expect. Let's start with where the overall stack ranks today. Across every layer, the top 10 by conviction. Number 1, NVIDIA, a 19-year CUDA moat, roughly 80% AI accelerator share, and $193.7 billion in data center revenue, the defining company of this decade. Number 2, Microsoft, OpenAI exclusivity, Azure growth, and over 350 million Copilot users. Number 3, Alphabet, vertically integrated across chips, models, and cloud, with a $460 billion backlog. Number 4, TSMC, the only company manufacturing the world's most advanced AI chips, a position that cannot be replicated for at least a decade. Number 5, Constellation Energy, 21 nuclear plants, and the exclusive power supplier behind Microsoft's 3 Mile Island restart. Number 6, Micron, HBM inside every Blackwell GPU, 81% gross margins. Number 7, Palantir, 85% revenue growth and a genuine product moat in enterprise AI. Number 8, CoreWeave, a $55 billion backlog, sold out through 2026 against real balance sheet leverage. Number 9, Meta, the open-source Llama bet plus 3.3 billion daily users. Number 10, Amazon, the largest cloud business by revenue, with the largest single capital expenditure commitment of any hyperscaler, but no frontier model of its own. This is analytical conviction on competitive positioning, not a directive to buy or sell anything. Now, the risks that could reorder this entire list. 6 structural risks deserve real attention, not boilerplate disclaimer language. The capital expenditure to revenue gap, where spending is running far ahead of monetized AI revenue. Humanoid robot timeline slippage, a pattern that has repeated across this entire category for a decade. Geopolitical and supply chain fragility, concentrated in a small number of irreplaceable facilities. GPU commoditization pressure on NVIDIA's pricing power. Open-source model commoditization threatening the entire API-based AI revenue model. And valuation compression risk across the stack simultaneously, given how correlated these companies have become. Let's take each one seriously, one at a time. The capital expenditure gap is the most important near-term risk. Over $700 billion committed in 2026 capital expenditure against roughly $25 billion in actual AI services revenue, a 28-to-1 ratio of spending to revenue. Amazon's free cash flow dropped roughly 95% on a trailing 12-month basis, and Meta's approached zero in the first quarter of 2026. The question for the next 2 years is whether enterprise AI revenue accelerates fast enough to justify spending that is already committed and still growing. Palantir and ServiceNow, both raising guidance, are encouraging early signals, but the gap genuinely has to close. Humanoid timeline slippage is not a new risk, but it deserves attention given current valuations. Optimus missed its 2025 delivery target entirely. Figure AI carries a $39 billion valuation against zero commercial revenue at scale, and the battery constraint alone caps realistic timelines until solid-state technology matures around 2028. A reasonable working assumption: expect delivery timelines across the humanoid category to run 18 months to 2 years behind management's own projections. GPU commoditization risk centers on NVIDIA at roughly $3.3 trillion in market capitalization. If AI workloads shift toward more efficient inference using smaller models, GPU demand could normalize and pricing power could erode, with hyperscaler custom silicon potentially representing 20 to 30% of hyperscaler AI compute by 2027. Open source commoditization is its own structural threat. If Meta's next Llama release reaches genuine frontier quality, the revenue model for API-first providers like OpenAI and Anthropic comes under real pressure. though the infrastructure layer underneath would still win regardless, since open-source models still need chips, power, and data centers to run. And the valuation reset risk is simple correlation. Palantir trading over 100 times trailing revenue, NVIDIA at elevated forward multiples, CoreWeave's leverage. Any AI revenue miss at a major hyperscaler could trigger multiple compression across the entire stack at once, because there is very little true diversification within this sector against a sector-wide sentiment shift. On Tesla specifically, the same Reuters investigation into full self-driving safety statistics, pending regulatory permits in California and the European Union, and active lawsuits across multiple jurisdictions all argue for building in real delay versus management's own stated timelines. Now, the geopolitical risk that ties several of these together. TSMC manufactures roughly 92% of the world's most advanced logic chips. A serious conflict in the Taiwan Strait would not raise prices. It would halt global advanced semiconductor production entirely for an estimated 2 to 5 years, while alternative manufacturing capacity is built and yields are learned elsewhere. TSMC's Arizona facility, expected to represent only about 10% of total capacity by 2027, is a meaningful hedge, not a solution to that risk. China separately controls roughly 85% of global rare earth processing, the neodymium and dysprosium used in every electric motor, every robot actuator, and every wind turbine generator, and has already applied export restrictions on gallium and germanium, with no quick fix available since alternative processing capacity outside China is roughly a decade-long investment cycle. The harmonic drive gearbox concentration covered earlier in robotics belongs here too. 70% of global supply from 2 Japanese companies means a major regional earthquake could halt the entire global humanoid industry, not just slow it. And ASML's complete monopoly on extreme ultraviolet lithography, already restricted from selling into China, effectively extends TSMC's manufacturing advantage by denying competitors access to the one tool needed to manufacture leading-edge chips at all. None of these are abstract tail risks. They are single points of failure embedded directly inside an otherwise bullish thesis, and an honest analysis has to carry them forward explicitly. Step back and look at these choke points together rather than individually, and a pattern emerges. Nearly every layer of this stack depends on a small number of irreplaceable, geographically concentrated suppliers. Grid interconnection queues running 5 to 7 years. TSMC's foundry leadership requiring a decade or more to replicate. ASML's lithography monopoly, fully export-controlled. SK Hynix and Micron's high-bandwidth memory yield curves. 2 Japanese companies controlling precision robot gearboxes. China controlling the rare earth processing every electric motor on Earth depends on. Each constraint, taken alone, simply slows growth at the margin. Taken together, they describe a supply chain with very little redundancy at its most critical nodes, which is precisely why the companies sitting at those nodes capture outsized pricing power today, and precisely why any disruption at one of those nodes would propagate through every layer above it almost immediately. Understanding this interconnectedness is, in many ways, more useful than memorizing any single company's quarterly numbers. Now, the broader geopolitical competition sitting underneath all of it. The United States currently leads in AI compute, with NVIDIA holding over 90% AI GPU market share. Leads in frontier models through OpenAI, Anthropic, and Google. Leads in humanoid funding across Tesla, Figure AI, Boston Dynamics, and Agility. Leads in autonomous vehicles through Waymo's over 250,000 weekly rides. And leads in defense AI through Palantir's Titan platform. China is not standing still. DeepSeek's R1 model, released as open source in early 2025, rivaled GPT-4 class performance at a fraction of the training cost, demonstrating that Chinese AI research is closer to the frontier than export controls were designed to ensure. Unitree's $16,000 humanoid is commercially shipping to North America today. Baidu's Apollo Go autonomous ride service is rivaling Waymo's scale, and China is applying the same aggressive manufacturing cost curve compression to robotics that it already applied successfully to solar panels and electric vehicles. The most important open competitive question is whether China closes the semiconductor gap. Huawei's Ascend chip currently sits roughly 2 generations behind NVIDIA's Frontier silicon, but over $100 billion in Chinese government investment in domestic chip capability represents a genuine long-term risk to that lead, even while near-term export controls remain effective. Layered on top of this national competition is the platform war for physical AI itself. NVIDIA's Isaac platform pursuing hardware-level dominance, Google's Gemini robotics pursuing model-level dominance, OpenAI backing Figure AI directly, and Tesla betting everything on full vertical integration. Whoever wins that platform war effectively collects a toll on every robot built for decades to come. Not every layer's demand is equally durable, and separating structural demand from cyclical demand is one of the most useful exercises in this entire analysis. Energy infrastructure, at peak demand right now, still at peak in 2 to 3 years, and high for at least 10 years out. Power purchase agreements are already signed and nuclear plant licenses run 40 to 60 years, making this demand essentially irreversible. Advanced foundry capacity, TSMC specifically, at peak now and staying at peak through the next decade, because designing a custom chip on a given process node commits a hyperscaler to that node for 5 to 7 years minimum. Humanoid robots, genuinely early today, still early in 2 to 3 years, only reaching medium maturity in 5 years, and only peaking 10+ years out. This is, without question, a decade-long story, not a 2-year trade. Enterprise applications, medium today, high in 2 to 3 years, and peaking in 5 to 10 years, with Palantir as the clear exception that has already crystallized ahead of the rest of the category. The investment implication is straightforward. The earliest, most durable value capture comes from owning the physical constraints that cannot be expanded quickly: energy, advanced packaging, foundry capacity, and high bandwidth memory. The application layer captures value once its adoption curve actually inflects, which for most categories outside Palantir is still several years away. Now, the analytical principles that tie this entire framework together. 6 principles for evaluating any company that claims AI infrastructure exposure, distilled from everything covered so far. 1. Follow the physics, not the headlines. When TSMC says a new fab takes 5 years to reach yield, or ASML says it can only build 60 machines a year, believe the physical constraint over the press release. 2. Identify the specific choke point inside each layer. Energy has grid queues and licensing, chips have foundry and lithography capacity, robotics has precision gearboxes and battery density, and recognize that the company controlling the choke point captures outsized value regardless of who's loudest in the headlines. 3. Ask explicitly whether AI strengthens or threatens a given company's moat, because the answer is different for every business. AI strengthens ServiceNow's workflow lock-in, but threatens commodity software vendors by lowering switching costs. 4. Distinguish training demand from inference demand, since training requires the most powerful chips while inference can increasingly run on cheaper hardware, and the chip layer's competitive dynamics shift meaningfully as the industry moved from a training-dominated era toward an inference-dominated one. 5. For robotics specifically, follow the cost curve, not the demo. A robot is investable when its price crosses the threshold where its labor payback period becomes economically rational, not when its demo video goes viral. And 6. Map the supply chain before assessing demand, because every bullish narrative in this sector has a physical bottleneck somewhere that determines how fast it can actually happen. Now, the practical part, exactly what to track every single quarter. 3 categories of signals to track every quarter. First, AI infrastructure integrity. Watch hyperscaler capital expenditure guidance for any sign of deceleration below roughly $150 billion for 2027. Watch cloud AI revenue growth, which needs to sustain above 20% at AWS, Azure, and Google Cloud. Watch NVIDIA's Blackwell shipment volumes and gross margin, where any compression below 70% signals real pricing power erosion. And watch data center power availability, sense of binding. Constraint validates the nuclear thesis while an unexpectedly loosening grid queue would weaken it. Second, humanoid production KPIs. Boston Dynamics' actual deployed unit count at Hyundai facilities, Tesla's internal Optimus fleet size versus what was promised, figure AI's BotQ facility throughput against its 12,000 unit target, and any genuine announced cost reduction milestone toward that $20,000 threshold. Third, enterprise AI adoption. Palantir's U.S. commercial growth rate, where anything below 80% is a watch signal. ServiceNow's AI agent booking rates, and the percentage of total cloud revenue coming specifically from AI services, the clearest red on whether enterprise spending is actually following infrastructure spending. The single most important near-term catalyst across the entire report is each successive quarter's hyperscaler earnings call. That is where every one of these signals gets a fresh data point. Now, the open structural questions nobody can fully answer yet. 6 structural debates, with the honest case on both sides. Will compute scaling laws plateau? The bull case. No plateau has been observed across 6 orders of magnitude, and reasoning model scaling opens an entirely new frontier. The bear case. Diminishing returns on pure parameter scaling are already visible internally. And if the next capability leap requires a different architecture rather than more raw compute, NVIDIA's training dominance faces a real structural challenge. Will China close the semiconductor gap? Bull. Export controls have set Chinese AI chip development back 2 to 3 years. Bear. Over $100 billion in domestic investment could, over a decade, replicate the same industrial policy success China achieved in solar and electric vehicles. Will open-source models reach closed model quality? Bull. Frontier training runs costing $500 million to $1 billion create a systematic capability gap only the largest labs can close. Bear. Meta's existing Llama model is arguably already at GPT-4 class quality, and closing the remaining gap would meaningfully threaten the entire API-first revenue model. What is the real humanoid cost curve? Bull. Manufacturing scale could compress costs faster than historical robotics precedent suggests. Bear. Getting from current pricing to $20,000 requires roughly a 7 to 8 times cost reduction, and the battery constraint alone limits the realistic timeline regardless of manufacturing progress. Will custom chips displace NVIDIA inside hyperscalers? Bull. Custom silicon could represent 20 to 30% of hyperscaler AI compute by 2027, capturing the most predictable workloads. Bear. CUDA's generality remains the core moat, because a custom chip runs one architecture efficiently, while NVIDIA's GPU runs any architecture, any experiment, any framework, and training in particular still strongly favors that generality. And how fast will the power grid actually catch up? Bull. Small modular reactor progress could bring new capacity online faster than traditional grid queues suggest. Bear. Grid interconnection genuinely takes 5 to 7 years, even with full political will behind it, because physical infrastructure simply cannot be built faster than physics allows. Now, let's bring this entire report together. 5 ideas carry the complete thesis. 1. This is a capital war, and the infrastructure owners win first. Companies controlling nuclear power, advanced semiconductor manufacturing, high-bandwidth memory, and GPU cloud capacity capture returns regardless of which specific AI model ultimately wins, which is why the right question isn't whether AI works, but who actually captures the value. 2. The CUDA moat makes NVIDIA structurally different from every previous technology monopoly, because it is a developer ecosystem moat built from 19 years of accumulated code and professional training, not a hardware moat that can simply be reverse engineered. 3. Nuclear power is the only real answer to the AI energy problem, which is exactly why Constellation Energy's 21-plant fleet, under 20-year contracts with Microsoft and Meta, functions as an AI infrastructure investment rather than a traditional utility holding. For physical AI is in year one of the decade-long deployment cycle. Today's humanoid robots are roughly where smartphones were in 2006, technically impressive and commercially limited, and the 7 times cost reduction required to reach mass adoption will happen through manufacturing scale and battery improvement, but over 8 to 10 years, not 2 or 3. And 5. Palantir has already proven the enterprise AI application thesis. 85% revenue growth and a rule of 40 score of 145% are not projections. They are reported results, and they're the single clearest evidence available today that enterprise AI monetization is real rather than hypothetical. For long-term investors, the practical sequencing is infrastructure first, applications second, and humanoids third, with the quarterly KPIs covered earlier as the ongoing test of whether that sequencing remains correct. Now, the final compression of everything we've covered. Here is the entire report compressed into 3 sentences. AI is a generational infrastructure build-out. Robotics is AI's expansion into physical reality. And neither one is fully comprehensible without understanding the complete supply chain underneath it, the energy that powers it, the silicon that computes it, the cloud that scales it, the models that think with it, and the applications and machines that finally put it to work in the real world. We walk 10 layers and more than 30 companies today, from a single nuclear plant's power purchase agreement all the way to a humanoid robot's battery constraint. And every one of those layers connects directly to every other layer above and below it. This is education and research, not financial advice. Do your own due diligence and consult a qualified professional before acting on anything covered here. If this analysis added real value, the best way to support more of it is simple. Like the video, subscribe to the channel, and leave a comment with whatever you think we got wrong or missed entirely. Those comments genuinely shape what gets covered next. Thank you for spending this time with Dreamlit Equity Research. We'll see you in the next one.